Now this week, interest rates went up for the second consecutive month. The media is having a field day. What is it going to mean for house prices, for property investors, for jobs, for inflation, for all of these different things? Okay. I'll give you the first tip. Read too much of the news will just add to confusion, because what they do is they isolate one of these variables and talk about it as if it's the end of the world. When you understand what the fundamentals are and the interrelationship between interest rates going up and inflation and rents and house prices, it's a much different picture. It allows you to get much better clarity and make much more informed decisions. So, firstly, why have interest rates gone up? Well, interest rates have gone up because inflation is at levels that we haven't seen since the 1980s, just over 5%. The Reserve Bank are concerned by that, so they want to increase the cost of mortgages. So that gives you, in theory, less discretionary spending to be able to spend less effectively and bring inflation back down to their target range of 2 to 3%. Now, what's interesting around that is that a lot of the inflation at the moment is caused by things that aren't related at all to discretionary spending. Fruit and veg and food have gone up a lot in value because crops have been affected by flooding and other natural disasters recently, which has reduced supply. Petrol is one that anyone that's filled up in the last 3 months can relate to, right? Caused by the activities over in Ukraine, and again, lack of core supply, which means prices go up, because fundamentally around property, supply and demand is what drives house prices. So let's think about that. In an environment where we have high inflation, as I said, the last time that happened was in the 1980s. Do you know what happened to house prices and rents in the 1980s? Well, over that time, we saw interest rates go from 8% to 16% during the 1980s. But in that same time, capital city house prices in Australia increased by 160%. Now, so well over more than double. Okay? And what was linked to that was a rapid increase in rents. Okay? So it's really important to understand the interrelationship between rents increasing and prices increasing and interest rates increasing. So let's explore that. Why do rents go up? Well, rents go up because there's a shortage of housing. It's been very well documented that we're in a rental crisis. As the headlines tell us, vacancy rates under 2% nationally in a lot of the capital cities and high demand suburbs that we're investing in, under 1% even. So what we see in that scenario is significant rental gain. Clients of ours that bought 12 months ago, budgeting for $450 a week in rent, getting leases signed this week at $560 a week in rent. Clients of ours that have established property in their portfolio already, that's already leased, have seen rents go up $100 to $120 in some cases on lease renewals in the last 2 months. So there are some tangible examples of what rising rents means. Now, interest rates go up because there's a labour shortage, which in turn drives wage growth, okay? And because inflation is increasing. Now, if you've got more money in your pocket because your wage has gone up, then you can afford to pay more in rent and you can afford to pay more for a house. Okay? So that's what's driving rental growth, is the wage increase, more disposable income, and less available supply. Now, at some point, people that are renting, provided they've got the deposit, are going to want to move into the housing market as a buyer because of the extra rent that they're paying. So as they do that, that increases demand for buyers. So it's why we look at rental growth as a major indicator of when price growth is going to occur, and that's exactly what we've seen in the Southeast Queensland market and other capital city markets where we've been placing our clients into the last 12 to 18 months. Now, when we overlay this with the fact that as inflation rises, there are less new apartments, townhouses and houses being built, effectively we're having less supply come onto the market. It's been very well documented that the Australian government, because of the amount of money they've spent on COVID, need to rapidly grow our population and grow their revenue through income tax. So if we have less supply coming into an already constrained market and we have an overdose of overseas migration in the months and years ahead, then as investors, that puts us even better off in terms of this supply and demand dynamic. Okay? So that's why we're so positive around increasing interest rates and increasing inflation, resulting in increased price growth and rents. Okay? Fundamentally, you've got to understand the difference. Interest rates going up resonates with the majority of the population because the only debt that most Australians have is their own home. The only source of money they've got to service that mortgage is their own income post-tax. But as investors, if we are getting more tax benefits because we have more deductions because our interest repayment has gone up, and we are getting more in rent based on the supply and demand dynamic and the rental crisis, then we feel next to no impact to our cash flow at all. So doesn't it make sense to be holding more asset and investing now while there's general negative sentiment in the market? You can get better opportunities and position yourselves for the upswing that's going to come as these fundamentals start to recalibrate in the next 2 or 3 months, and people get comfortable with the fact that after all, the cash rate is at 0.85%. Historically, that's above 5%. So we're still in a very low interest rate environment, despite what's happened in the last 2 months. The fundamentals make sense, but what is critical is to get the right help to execute this strategy. Where does it make sense to buy? It's not in the top end of the market in Sydney and Melbourne. We expect those prices to come backwards, absolutely. But in the affordable centres, the affordable locations within Sydney and Melbourne, the more affordable capitals, we see them really well positioned for price growth. So if you want access to all of our research and analytics on where makes sense to buy and why we've beaten the market so consistently over the last 17 years, get in touch with our team. If you are paying more on your mortgage and you haven't refinanced in the last 2 years, we have a finance brokerage in-house to get you the right kind of structures and optimize your cash flow. Our team have been saving our clients thousands in loan repayments in the last 2 to 3 months. Finally, if you are a landlord, we've got property management team in-house to know exactly where the market rents are. Don't be increasing your rent by $5 or $10 a week because your property manager is lazy. Increase it as the market requires. And in such a tight rental market as we have now, there is a massive opportunity to put thousands extra rental income in your pocket right now. So if you need help with any of those things, get in touch. We can help. Hopefully that's helped give you some clarity around what the current environment means and where the opportunities are.